Hello from Paris and welcome to this webinar. My name is Howard Manton of the AU Group, and I'm delighted to be joined here today by Gilles Moec, who is the Chief Economist of AXA Group. Welcome, Gilles.
Thanks a lot.
AXA is a global group operating across 50 countries with annual revenues in excess of 100 billion. It handles general as well as life insurance and has over 900 billion euros of assets under its management. Very impressive. Today we've asked Gilles to give us his views and indeed predictions on changes in 2024 and beyond, which will have an impact on corporate business. We will consider what is happening and what might happen to interest rates globally, to the level of government support that businesses receive, as well as the increasing attention being paid to the ecological transition, which indeed is taking up a lot of government funding at the present time. The focus for our audience today is the threat and opportunity facing businesses both domestically and internationally. We now live in a very volatile world, both economically and politically, and there are higher levels of risk and potential threats of bad debts. There is a facility in this webinar for listeners to ask Gilles questions. If you have a look at the right-hand side of your screen, there's a Q&A box. So if you want to ask some questions, please type them there and we will select a few and put them to Gilles at the end of this presentation. I'm very grateful to Gilles for his time with us today. I did have an earlier call with Gilles for the intention of doing some preparation. And I was very relieved when Gilles said, "Don't worry, I've got this. All you have to do is introduce me. I'll do the rest." Thank you for that. Whilst the time slot for this webinar means that the majority of listeners will be in the Western Hemisphere, I would be interested to hear from you about your views that the impact of what's happening in China and that part of the world is having on the global economy. Interesting that Japan has recently ditched its policy of negative interest rates. So how do you see that unfolding and the impact it's having elsewhere around the world, Gilles?
Well, thanks a lot, Howard, and I'm not sure I got this, but thank you for inviting me and taking time to listen to my poor stories. Starting with your question about Asia, about China in particular. We are dealing with very, very soft demand coming from China. At the beginning, the general view is just a sort of after effect of the COVID pandemic. Things were normalized, and they really haven't normalized. An issue, I think, in China at the moment is that there's still a very strong preference for saving in the general population. And you can see that actually quite well in the data. Consumer spending still is not as strong as it should be. There has always been this preference for saving in China, but it's getting probably more acute, and it's colliding with the government's strategy, which initially was to say we're going to move our growth model from something that was highly dependent on exports and investment, and we're going to shift it towards something which is going to be more consumer driven, and it's not really happening. And an issue, I think, at the moment, and that's the reason why I'm not counting on that much acceleration in demand from China in the next 2-3 years, is very simply because the economic policy choices in Beijing are probably not conducive to a very quick revival of consumer spending. For instance, the Central Bank of China has recently cut its interest rate a little bit at the end of February. But if you look at where real interest rates are in China, the nominal policy rate minus inflation, or actually deflation, very often in the case of China these days, it's probably one of the highest level of real interest rate you can think of in any big economic region of the world at the moment. So it remains fairly poor, fairly soft. And that's a very big difference with what we'd been accustomed to over the last 30 years, where China was very often working as a sort of consumer of last resort. When everyone else was doing poorly, you could always count on Chinese demand, not necessarily consumer spending, but investment in particular. You could always count on Chinese demand. So it's not really happening at the moment. However, I would say the fact that China is, if not in deflation or on the brink of deflation, actually helps us, because our main issue right now in the West is to make sure that inflation is well and properly killed. And the fact that China, remaining the world's biggest producer of manufactured goods, is in deflation, is basically helping us in Europe, in the US, because we pay less for those crucial imports, and that helps drive the general level of prices down. So it's a mixed blessing, if you want. Not enough demand.
Inflation has remained stubbornly high, and higher than people were anticipating.
Inflation, well, it's a complicated story, I would say, on inflation. My usual quip on inflation for the US or for Europe was always to say, look, it's always easier to get inflation from 10% to 5 than to get it from 5 to 2. Why? Because usually when your inflation is at 10, it's because you have some sort of adverse external effect materializing. War in Ukraine.
COVID and, yeah.
Exactly. So, be it by construction, when those adverse effects disappear or fade, inflation tends to normalize. But the famous last mile of disinflation, that's because when you are in this 3-4% territory, where we often are at the moment in the West, it's often because you may have dealt with energy prices, you may have dealt with food prices, but domestic inflationary forces may be at work, and it's more painful to deal with them, because generally speaking, if you want to deal with your domestic forces, in particular with unit labor cost rising too fast, well, you need to slow down the economy, and this is what central banks are trying to do. So, I mean, the stage at which we are right now in the world economy is I think quite interesting, because 2002, 2022 and 23, it was all about making sure that monetary policy was stringent enough to get us towards a lower level of inflation. It's kind of done. We're not fully at 2%, but we're getting close to that. The question that central banks are all asking themselves at the moment is, should I wait until I'm absolutely sure inflation is back to 2, or should I start cutting right now?
Follow the Swiss example.
Exactly. And my hunch is that central banks are not going to wait until inflation is exactly at 2% before cutting. Actually, in the case of the Swiss National Bank, at least they could say, well, in Switzerland at least, inflation has fallen a lot. It's not the case in the US, it's not the case in the euro area. Yes, yet Jay Powell, the chairman of the Fed, was very clear, I think, last week when he said, we need to take into account transmission lags. We don't need to see inflation at 2 before we start cutting. Governor Bailey from the Bank of England said exactly the same thing last week, and I think the message we're getting from the ECB are all going in the same direction. So my impression is that as central banks are really concerned with the risk of maintaining a level of monetary restriction that would be too penalizing, that would actually get us into a proper recession, not the kind of stagnation that we have right now in Europe, but a proper recession. They're probably going to stop quickly. My guess is that we'll get the first cut from the Fed, from the ECB, and from the Bank of England in June of this year. Yeah. And this has, I think, important consequences for the way which you think about inflation and rates on a medium to long-term basis, because the graph you have here on this slide, on the left-hand side, that's for Europe, but you could do exactly the same thing for the US. So the pink line, that's the level of consumer prices if inflation was all the time at 2%. The green line, that's where inflation actually, where our consumer prices actually are, the level of prices. As you can see, we've had this fairly long period of time after the great financial crisis when consumer prices failed to be as strong as they should have been if central banks had been able to actually deliver their target. Because price stability is not about zero inflation, it's about 2% inflation.
And do you see, or did you see central banks acting in a very coordinated way at the beginning of this and less coordinated now as each tries to adapt policy to suit their own geographical needs, or are they all fairly coordinated?
Well, there's the other one out. The other one out is the Bank of Japan, which has just started to hike rates. I think they're going to be very cautious, very prudent about this, but they're in a very different situation.
And hiking rates is still from a zero.
Yeah, from zero, minus to zero.
Yeah.
And they've been through 20, 30 odd years of deflation, so they're in a complete different situation. For the ECB, the Bank of England and the Fed, I think it's more synchronized, probably because we had similar types of shocks. But my main point is that when you've had the kind of inflation shock that we've had over the last 2-3 years, it doesn't disappear like this. From the economy. It leaves actually deep scars. And it means that when people start thinking, for instance, about the way they are going to negotiate their wages, they think again about inflation. I'm in my 50s. Honestly, for the first 20 years of my career, I never thought about, well, inflation is at 2%. I need to make sure that my wage rises at least by 2% every year. Now that we've had such a massive inflation shock, people are going probably to be much more demanding. So that's a reason to believe that maybe there will be a form of persistence of inflation. There are also structural forces which may push inflation a bit higher. We'll talk about it later, but the transition to a net zero economy is probably inflationary. Demographic changes are probably also conducive to more inflation. So what I put on this graph on the left-hand side is to say, look, we're not going to come back to the near deflation phase that we had before 2015 and 2021. We probably should see 2% inflation, which is the central bank's target, as a floor and not as a ceiling. It used to be a ceiling.
Yeah.
It will probably become a floor.
And as you said, people became accustomed over so many years to living in that period of low inflation, low interest rates, and got spoilt as a result.
Got spoiled, or I mean, it's, pompously in economics we call this adaptative expectations. You just see what's been going on and you tend to extrapolate. What people have seen is that inflation shocks can happen, and most people had never seen that. The last big inflation shock in the Western world ended in 1980. Yes, 24 years ago.
Yeah. Okay. And in terms of inflation, so you're saying 2% is going to be the floor in the future.
Probably.
That's what they will aim at.
Probably. And if you think that 2% inflation is the floor, it probably has an impact on where we should and how we should think about the sort of cruise level of interest rates. Because one of the reasons central banks got into those crazy monetary policies, I don't think they were crazy, they had to do it, but unconventional policies with negative rates, QE and so on and so forth, was because we were constantly at this risk of deflation. If instead we are dealing with an inflation which is probably on average slightly higher than 2%, central banks won't have to get into those extreme measures. They will rely on conventional policy, and bond investors will also probably take 2% inflation as a floor and not as a ceiling. So when it comes to pricing long-term interest rates, I think we won't come back to the situation we had before COVID, where very often we had 10-year yields, at 1% or 1.5%. And this can have actually significant consequences, not just for businesses, but also for governments. Because for the last 15, 20 years, governments have been very, very lucky in the way they've been managing their public finances, because we had the benefit of the end of the Cold War in the early 1990s. Military spending fell by a large amount, especially in Europe, but basically everywhere. So that freed up some space for traditional spending or social spending, for instance. And then on top of that, interest rates fell significantly, so that the cost of servicing public debt fell as well. So we're in a situation where governments could afford to respond to crises, to respond not even to crises, but even small bumps on the road. I think we should consider this era as over. There might be differences across geographies, but what is clear to me is that in Europe in particular, there's a very clear awareness that, I'm not going to call it austerity, but we've probably reached the point at which fiscal policy will have to become more stringent, will weigh on domestic demand, and we will probably see a reduction in the capacity of the government to help along at a time when social demand for government intervention is rising. And that's, for me, that's the tension.
And how do you see, Gilles, the effect of the sort of forthcoming elections across Europe is going to have on government policy?
At the risk of being cynical, I don't think the European elections, which come in June, will have much of a bearing on fiscal policy or on social policy. If anything, because one of the potential outcome of the European elections is that the European Parliament would be harder to manage, because it could be split across more groups, or the usual traditional triumvirate between the socialists, the centre-right, and the liberals may be in jeopardy. So it may be harder to manage. If it's harder to manage, it will be, I think, harder for the EU to develop new ideas and to go into new territories. But would this have a bearing on national policies? I don't necessarily think so. And you can see why, for different reasons, every country in Europe is moving in the same direction. The UK has started actually austerity pretty soon, after a moment of, let's say, adventure last year, which didn't last very long.
You're being very polite.
France is now also moving into cutting some expenditure programs. Germany, and that's always the paradox with Germany, Germany is the only country in the euro area which could afford to run a fairly accommodative fiscal policy. The German economy is in trouble. They are dealing with lack of demand from China, which matters a lot to them. The possibility of yet another protectionist push coming from the US. Energy issues, which has been very detrimental to Germany as a location for production. So when you look at this, and me being French, I look at that and say, okay, these guys have only 60% of GDP worth of debt. They could very easily spend some public money to go through this complicated period. But for legal reasons, for constitutional reasons, they're actually forced into quite a significant dollop of austerity in 2024 already. So we are in this weird situation in Europe where even the country which could very well maintain a very accommodative fiscal policy cannot. So we're probably going to see a measure of, yes, austerity everywhere. Why? Because governments start to feel the pressure from the market. They can see that the cost of servicing debt is rising. And we have a number of governments, especially in Europe, who live with the memory of the sovereign crisis of 10 years ago, which was extraordinarily painful. Some core countries completely escaped the crisis, but it's not true for Italy, it's not true for Spain, etc., etc. So there is this awareness of always the possibility that there's going to be significant bond market pressure, which will force extra austerity from the country and could get us into crisis territory. So they will probably always want to act and reduce deficits before the pressure from the market is there. The key issue is actually more in the US, because as much as people know well about the sorry state of public finances in Europe, very often people turn a sort of blind eye to what's going on in the US, which actually is getting scary as well. So the graph on the left-hand side here, that's a projection of public debt in the US by the Congressional Budget Office, which is bipartisan organization, very respected. It's what they call a no policy change scenario. So basically, you continue assuming that governments are simply going to maintain the current policy setup. And that would get you to public debt of 200% of GDP by 2050. So it's quite scary. Obviously, we're used to those endless debates in Washington, D.C. about the debt ceiling, about those late hour discussions to make sure that there is still a budget. But what is always frustrating is that those discussions, those debates are focused on a tiny part of US public spending. They usually focus on what they call non-monetary ex-military spending. That's roughly 5% of GDP, which means that we're talking about 1/6 of total public spending in the US. No one really talks about, the big programs, Medicare, Medicaid, et cetera, or Social Security. It's a figure I often use when I'm in France. The average pension paid by the Social Security Administration in the US is at $1,700 a month. That's exactly the same amount as the average pension paid by the social security system in France. And France is obviously reputed for its very generous pension system. Well, the US federal system is just as generous. So the difference obviously between Europe and the US is that you've got those spending commitments without the tax receipts that in Europe we consented to. So there's definitely a conversation to be had in the US as well, but for many reasons and political polarization in particular, there is no real conversation on this. It's a bit of a ticking bomb. We know that something needs to be done at some point. We just don't know when. And when you look at the history of public spending in the US, which I put on the right-hand side, there are fluctuations, obviously, but the trend is up. And I really like to look at the Reagan years because obviously, it's a bit old. I do remember Reagan as president of the United States, but many in the audience probably don't. But Reagan was the president of the US who was probably the most vocal about cutting public spending. And he didn't. Even he didn't. Public spending actually rose during the Reagan years. So it's very complicated to get public spending under control, even in the US. All this long digression to get me back to what I was saying about interest rates. If you believe that inflation is going to be on trend higher than what it used to be, even if it's just a bit, and if you factor in the fact that all those governments are going to be forced to issue a lot of bonds in the market to fund those deficits, that's a good reason to believe that even if central banks, the Fed, the ECB, the Bank of England, are going to cut rates in 2024, they're short-term, they're policy rates, long-term rates could actually remain fairly high.
And turning this into sort of the corporate scene, you're painting a picture of what's happening around the world. What should be on the mind of our clients listening in today in terms of what they're looking to do with their businesses, how they grow them, how they stop having real problems if they're trading both domestically in their own markets, but more and more internationally?
Yes. First of all, the point I'm making on public finances, I think it really matters for businesses because obviously governments everywhere in the world, but particularly in the West, are big clients of private businesses. And this big client is going to will have to think twice about spending more money in the years ahead. So if you run a business and a large chunk of your turnover comes from contracting with governments, you probably have to think it over and make sure that the government it's the right strategy, and that you're dealing with properly solvent public sector outfits. Second point I would make is we need to be mindful of the possibility that at some point down the road, governments will be forced to hike taxes. Also, same thing, we've been operating in the private sector for the last 30 years under a nearly constant trend of falling taxation. Mm-hmm. It's probably over.
Okay.
We've already seen it, for instance, with this international decision to agree on a minimum corporate tax rate. But we're probably going to see more and more pressure across governments to start looking into the deep pockets of some industries. And there's a number of sectors of industries which have seen a fairly strong increase in margins, in profit margins in the last 2 years, during especially at the beginning of the inflationary shock. Mm-hmm. I'm not sure that those reserves of cash will be left untouched by governments in the years ahead.
And yet at the same time, governments need to encourage companies, the corporate world, to invest in their businesses. So you've got sort of the tax on the one side, which is preventative, and yes. How do they incentivize companies to continue investing? Especially in a situation where interest rates rise on trend, or at least do not fall as much as maybe could have been expected. We have an interesting situation right now, and it's a bit different across the Atlantic. In the US, what is actually a bit surprising is that, at least if you look at the national accounts, despite the fairly big hikes we've had from the Fed, the actual quantum of interest paid by the corporate sector has not increased that much over the last 2-3 years. One of the reasons probably being that during this long phase of nearly zero interest rates, especially on the long end of the curve, a lot of companies have extended a lot the maturity of their debt. So that it takes longer than usual for businesses to be faced with what is called the refinancing cliff, the moment where you have to go back to the market and reissue at a higher interest rate. So 2024, we may have a slightly blurred picture of what's going on. There hasn't been a massive increase in defaults, for instance. There hasn't been a massive increase in the amount of money that corporates have to pay on their financial liabilities. But we know that come 2025, actually there will be more and more debt which will have to be refinanced at a higher interest rate. So we have to be mindful of that. The situation in which we are at the moment might be a little bit overly nice because we haven't yet seen the bulk of the impact of the monetary tightening. It's a bit different in Europe, where we can see already in national accounts that corporations are paying more and more on their debt. But that is probably going to be a focus. When you do business, when you think about the counterparts with whom you're interacting, you probably don't want to deal too much with companies which are over leveraged. Sure, and in everybody's world, business as well as personal, people want to see stability. And I suppose everything that you've been saying, we've gone from a period of instability and transitioning to a period of greater, certainty is probably the wrong word, but people being more aware of what the likelihood is of interest rates and inflation.
Or is
that oversimplifying things?
What is reassuring is that when you look at surveys, consumer surveys, for instance, people never really believed in a sort of massive acceleration in inflation in the long term. There was an uptick in their even in their long-term inflation forecast. You could see an uptick, but it was not a massive uptick. And I remember that in 2022 there was actually a conversation about the risk that the inflation shock that we had seen would morph into a sort of 1970s-like scenario, with an inflation staying very elevated for a long period of time. That has probably gone away, because central banks have reacted, and we've seen actually that inflation has started to fall back. So we are now in a different situation where instead of thinking, wow, maybe inflation is going to exceed 5% for 5, 6, 7 years in a row, we're more into it's not going to come back to 2, but it may stop at 3 or something like this. So it's from this point of view, yes, it's less scary. Where I think there is still an uncertainty is, for instance, we don't know how central banks are going to react to some decisions by governments. As long as, for instance, in Europe, I think in Europe it's pretty clear. Governments are going to reduce the deficits. It's going to be painful, but central banks can also be sure that because there's going to be fiscal austerity, demand is going to be dampened. So there is not much central banks need to do to control inflation. So you have a sort of natural cooperation between monetary policy and fiscal policy. In the US, we don't know. In the US, we don't know. At some point, something needs to be done, but neither of the two candidates have come up with a plan to reduce deficits. So if you're the Fed and you're waiting for the results of the elections, how are you going to respond?
Yeah. Just moving you on, conscious of the time, and talking about the difference between the US and Europe, ecological transition, carbon neutral, a lot of government support in the US for companies, increasing concerns about the impact this is going to have upon certain sectors of society or business in Europe. How do you see this impacting the corporate world in terms of, because there's going to be an opportunity there, but also a potential threat?
The way I would describe policies in particular across the Atlantic on the transition is that in the US at the moment it's all about carrots, whereas in Europe it's a mixture of carrot and sticks. And this makes a bit of a difference for the business sector, because if you look at the US and the Inflation Reduction Act, which is not about reducing inflation, which is about funding the transition to net zero, it's just great, the money just pouring, not that many question asks, and there's no limit. Actually, I think in Europe we would never design something like this. For instance, if you take the tax credit on electric cars, there's no ceiling. So if tomorrow Americans decide that they all want an electric car, well, the government will have to fork out the subsidy. We would not do this in Europe. From a fiscal point of view, the IRA is actually very bold, and you could almost say it's a bit dangerous. But it's all carrots, so it's nice, and it's also a policy which very often allows the same company to actually do renewables, funded by public money, and also do coal. It's fine. You can do both. We don't do that in Europe. The other difference, I think, has to do with the regulatory environment. In Europe, I think we have probably the most comprehensive legal framework for the transition. We have, for instance, in green finance, we now have directives making it clear what is a green investment fund, what is not. We have CSDR, which will be effective next year, which will force companies to disclose, for instance, their carbon footprint and so forth. So we'll have a wealth of data, and we'll have a pretty clear legal environment to deal with this. For the time being, it doesn't exist in the US, but I think to some extent, this divorce between the US and Europe on these matters is also, it's not just cultural or ideological. I think it also reflects difference in terms of short-term economic interest.
And they're supposed to be cooperating.
And they're supposed to be cooperating, but I don't think they actually can very easily.
No.
Because, first of all, we need to deal with that. It's actually untrue to say that the US is not doing anything on the transition. If you look at this graph on the left-hand side, so that's CO2 emissions per unit of GDP, expressed in dollars. Okay, so how much carbon do you emit every time you produce something, on average? As you can see, in the US, between 2010 and 2020, there has been actually a fairly significant drop in the carbon intensity of the economy, which has actually exceeded the drop that we've seen in countries such as Germany or France. But what is clear is just the difference in level. Is that France is a very already decarbonized economy. Germany is much less decarbonized, in particular because of their energy choices. And the US is even less decarbonized. So very simply, if you say we want to go to net zero, well, there's a cost associated to going to net zero. And this cost is going to be much higher for an economy, a fairly energy-intensive economy such as the US, relative to what's going on in Europe. So that they want to do it differently, I think, is not really surprising. And then there's the big issue of China.
Still building coal-fired power stations.
Still building coal stations. Actually, they too have a reduction in their carbon intensity. It's the same thing. They are doing stuff, but not enough and not quickly enough. But we have this massive geopolitical rivalry between the US and China. And the way the US is increasingly looking at the net zero transition is to say, why should I actually spend that much? Why should I do these efforts where actually at the moment a lot of the contribution to climate change doesn't come from the West, but actually comes from China? So if you add geopolitical considerations in the mix, you have this reluctance in the US. And the other issue is what you have on the right-hand side. Electricity, the price of electricity in the US is incredibly low. So since we are in this sort of friendly war as to who is going to attract capital, who is going to attract manufacturing jobs in particular, the fact that
distinct
the price,
advantage in the US.
It's a distinctive, and they just don't want to lose it. So I think we need to be, clear about this. I mean, it's not just about politics. It's not just about values. It's also about hard-nosed economic interests. What worries me a bit is that obviously climate change is a worldwide issue. So if there's an issue on which we should cooperate, it's that. And what strikes me is that I remember that moment after the great financial crisis when we had actually countries getting together to come up, for instance, with very similar financial regulations. The G20 at that moment played a big role. We should have exactly the same thing today. We should have coordinated efforts to come up, for instance, with the same regulatory framework on green finance, on the green transition. We don't have it. One of the reasons we don't have it, competition.
Different vested interests. Yeah. You talk about geopolitical events. One of the questions that have just come through, how do you see a future Trump administration impacting the world, bearing in mind he's got a very protectionist policy, although people say he'll be less damaging to carbon neutral policy. So how do you see that having an impact?
Well, we have to start with what he says, right? And actually we should...
Well, it's brave.
Yeah, but...
What he says and what he does, sometimes two different things.
Yeah, but actually in 2016, if we had just looked at what he was actually saying, a lot of what he actually ended up doing was in the open. There was not that much surprise. And on protectionism, and you're right, I think it's the number one issue. So he's come up with this idea that there should be an increase in US tariffs on imported goods, of 10%. To give you a sense of what it means, the current average tariff in the US on imported goods is 3.4. So we're talking about a tripling. So it would not go unnoticed. On top of that, there would be a special 60% duty on Chinese products. And what really, and from 25 at the moment, so same thing, absolutely not the same order of magnitude of what we had during his first mandate. If you read carefully what some of these advisors have been saying, and I follow a lot Peter Navarro, who is his trade advisor, and Peter Navarro, PhD from Harvard. I mean, he knows his stuff, and he came up with a pretty consistent story. His point is, some of that is pure leverage. We're going to say we're going to slap those tariffs, but if the other countries agree to dismantle their own barriers, we won't have to deliver them. The problem is that in many cases it's going to be very difficult to get to any sort of agreement. Think of the relationship with the EU, for instance. One thing that US negotiators would want from the EU on any kind of trade discussion, and they've always been clear on that, the end of what we call cultural exception, especially in France, and the protection of cultural goods, and agriculture. That's not going to go down very well in Paris either. I don't think it would go down very well in Ireland, Spain, or Italy. Yeah. So it would be very, very tense anyway. My main concern, if that policy ends up being enacted, is that other countries would react by allowing their currencies to depreciate massively. And as a business message, I think it's also something we need to keep an eye on. So far, we've had fairly synchronized movements by monetary policy, so that exchange rate volatility has been manageable. Now, if we go into a Trump 2.0 administration with protectionist push, if I'm China, if I'm Europe, if I'm Brazil, even if I'm Mexico, I may be tempted to allow my currency to depreciate. So we would end up with a very steep appreciation of the dollar, depreciation of the currencies, with the risk that we end up in a sort of race to the bottom. Think about, for instance, China versus Europe. China could be faced with a tariff hike of 60%. Europe would be faced with a tariff hike by 10%. So normally, China should depreciate by more than Europe. But then that means that Chinese products would gain competitiveness on the European market. And governments in Europe are already very nervous about the risks to some key industrial sectors, such as the car industry, coming from the competition from China. So we could end up in a situation where everyone is trying to, that's called competitive devaluation. You try to work your currency down as much as possible because you simply see that the other player is doing it as well. And so it's a negative sum game. But that's a real risk.
Okay. Another question which has been asked, artificial intelligence. How do you see that changing, sort of modelling economic policy? At the moment, it's all people deciding with various statistics and algorithms. But with AI, do you see that as a big threat to economic forecasting?
To economic forecasting, possibly. But we should also see it as a chance for the economy. I mean, it's funny how a lot of the press coverage of AI is actually quite negative when it comes to economic consequences. It's all about the jobs that are going to disappear and so forth. Now, I don't want to be the starry-eyed economist, but productivity gains are good. It's actually the basis of economic growth. If we need less time to do more, that's great. That's the root of an increased potential growth. For the last 20 years, potential growth, especially in Europe, has been mediocre. I mean, trend growth in Europe is at around 1%. We definitely need stronger trend growth, if only to deal with our public finances problems. And AI is one of the options. It's a productivity enhancing tool.
But for that, people need to invest, or countries need to invest.
Indeed.
Which is going to be at different levels, presumably.
Indeed, and so far, that is also an element of this divergence between the US and Europe. What is really impressive is that if you look at investment in software and R&D in general, in the US there has been a very steep acceleration since 2015, roughly. Mm-hmm. In Europe, we completely missed that acceleration. Obviously, we have those frameworks now being put in place at the EU level in particular to try to activate CapEx on software, CapEx on AI in particular. We need to catch up because the US is well ahead of Europe at the moment on this.
Okay. Last question. If you, as you do, look at what's happening around the world, what particular events or event are you watching particularly closely which you think would have both a positive or a detrimental impact upon business?
Yeah, I'm increasingly looking at what I would call the clubification of the world economy. So
clubification.
The clubification. Okay. So it's different from deglobalization. So deglobalization is this idea that international trade is going to fall, international financial relationships are going to get less and less intense. I don't really believe that, and there is no data that would actually prove that this is happening. However, I'm increasingly drawn to the idea that there is a form of globalization, but instead of trading with everyone and having financial relationships with everyone, you trade and you invest with friends, okay, with political, geopolitical friends. So you have the sort of constitution of blocks, which would be increasingly independent from each other. So there would still be, lots of international relations, lots of, cross-border activity and so forth, but within those clubs.
So special relationships.
Special relationships, yeah. And it's interesting to see who is going to fall where. And one country which I think is really fascinating to follow at the moment is India. Mm-hmm. Where will India fall? Because I think it's clear that the world is looking for sort of China 2.0 and a substitute for China, which could be another source of traction in the next 10, 20 years. And India, because of its size, is obviously one of those possibilities. But where would they fit in this clubified world economy? There might actually be an integrator, a country, one of the few countries which would actually trade with everyone and still act as an integrator. But yeah, honestly, I haven't invested enough time in looking at India for a long period of time. I'm now looking increasingly at this economy because it may be sort of balancing factor in the world economy in the years ahead.
Okay. Thank you. Gilles, it's been fascinating. Thank you very much for joining us this afternoon. Appreciate that, your insight. For those people listening, watching, thank you for your participation. This will be recorded and available, I think, from tomorrow. So for those people who haven't seen it, there'll be a chance to catch up. Gilles, again, our thanks.
Yeah, thank you.
Appreciate it.